Are you starting to look into buying your first home? If so, you've probably come across FHA and conventional loans, and maybe you've even heard people say that conventional is better than FHA. But you still might be wondering exactly what the differences are and how the two loans work. Well, today we're going to take a closer look and compare the two loan types so you can make the best choice for your situation. Hey guys, it's Ron Piro, the loan professor. As I was saying, you might have heard of FHA loans and conventional loans, but maybe you're still not quite sure how they work and what the difference is between the two. A conventional mortgage loan is the most common type of mortgage loan in the United States. It's what most people think of as a standard mortgage loan. A conventional loan works the best for someone who is well established in their job and who has built up at least some liquid assets and who has at least a pretty good credit score. But for someone who is less well established, maybe because they're just starting out in life and maybe they have a new career and new family and maybe they haven't had enough time yet to save up assets or establish their credit yet, a conventional loan might not be the best fit. For these people, the best alternative is usually an FHA loan. An FHA loan has more relaxed requirements when it comes to credit score, and it's also easier to qualify for an FHA loan if you have higher debt ratio. When lenders evaluate your loan application, they look at what is called your debt ratio. There's two parts to your debt ratio called your front-end ratio and your back-end ratio or total ratio. Debt ratio is calculated by dividing your monthly payments into your gross monthly income. The gross income means your income before anything is withheld, such as taxes or insurance. For example, if you earn $60,000 per year, your monthly gross would be $5,000. So let's say the new house payment is $2,000. To get the front-end ratio, we divide the new house payment into the gross monthly income. So we take $2,000 divided into $5,000. This gives us 0.40 or 40% for the front-end ratio. The back-end or total debt ratio would be simply be all of the minimum monthly payments plus the new house payment divided into the monthly gross. So to continue our example, let's say you also have a car payment of $200 and a credit card with a minimum monthly payment of $100. So the total of the monthly payments would be $2,500. So now we take total debts divided by gross monthly income, or $2,500, divided into $5,000, which gives us 0.50 or 50% total debt ratio. With a conventional loan, the maximum total debt ratio is about 50%. But for an FHA, the maximum can go up to about 55%. That extra 5% allowed for an FHA loan can really make a difference for first-time buyers with lower income and possibly more monthly payments, just again because they're just starting out. The minimum credit score needed to qualify for a conventional loan is at least a 620. Some lenders even set the minimum as high as 640. On the other hand, the minimum credit score to qualify for an FHA loan is technically 500 based on FHA rules. But there is a catch. If your score is between 500 and 579, you'll need to have at least a 10% down payment to qualify. Even though FHA will go down to 500, most lenders set the minimum at 580. If you have less than a 20% equity stake in the property with a conventional loan, the lender will require you to have what's called private mortgage insurance, or PMI. This insurance protects the lender if the borrower defaults on the loan. It's necessary because a distressed house often sells for only about 80% of the peak market value. Without PMI in this situation, the lender would likely end up in the red for the deal if the borrower were to default. Ideally, the goal with a conventional loan is to establish a 20% equity position. This can happen either by paying down the loan, by the house appreciating in value, or through a combination of both. So once a borrower reaches 20% equity, if they're in good standing with the loan repayments, they can request to have the PMI canceled. An FHA loan also has mortgage insurance, but it works quite a bit differently, as we'll see in just a moment. First, I want to explain how the down payments work, because the down payment has a big impact on the mortgage insurance. The minimum down payment for a conventional loan is 3%, which is actually lower than FHA, which has a minimum down payment of 3.5%. With a conventional loan, PMI is usually included in the monthly payment, and it's priced individually for each borrower. Factors like your credit score, your down payment percentage, and other elements determine the rate that you're going to pay in PMI. The biggest of these factors is the percentage that you put down as a down payment. PMI rates typically range from 0.3% with 15% down to 1.5% of the loan amount per year with only 3% down. To calculate it, we multiply this percentage by the mortgage balance, and then we divide by 12 to get the monthly amount. So at 0.3%, that's $200,000 times 0.003 divided by 12 for 12 monthly payments of the year. This comes out to $50 per month. At 1.5%, we multiply our $200,000 times 0.015 and again divide by 12. So this time we get $250 per month. With an FHA loan, mortgage insurance has two parts, an upfront premium and a monthly premium. The upfront portion, called the Upfront Mortgage Insurance Premium, or UFMIP, is currently 1.75% of the loan amount and is usually rolled into the loan, so you don't have to pay this out of pocket. The monthly portion is about 0.55% of the mortgage balance per year. So back to our $200,000 loan example, we take our $200,000 loan amount times 0.0055 and again divide by 12 for 12 months of the year, so we get $91.67 per month. So just to make sure that this was clear, in this example, the mortgage insurance for a conventional with only 3% down will cost about $250 per month compared to only $91.67 per month with an FHA with 3.5% down. This difference is one of the biggest reasons why an FHA loan can be a better choice for a first-time buyer who is putting down the minimum compared to a conventional loan. With an FHA loan, the rules are more relaxed regarding minimum credit score and maximum debt ratio, and underwriters tend to be more forgiving overall. For example, the waiting period after a Chapter 7 bankruptcy is only 2 years for FHA loans compared to 4 years for conventional loans. However, there are two notable exceptions when it comes to qualifying for an FHA loan. One, borrowers who are non-permanent resident aliens or foreign nationals cannot qualify for an FHA loan as of May 2025. Two, borrowers with a strong work history and solid assets but little or no credit history, meaning they don't have a credit score, may still qualify for a conventional mortgage, but they cannot qualify for an FHA loan. When you buy a house, you always need an appraisal, which is just a professional opinion of what the house is worth. Conventional appraisals focus almost exclusively on the value of the property. Beyond ensuring basic habitability, the appraisal's purpose is simply to confirm that the house is worth the sales price. Because FHA loans are specifically designed for first-time homebuyers, the appraisal process is intended to protect the buyer by ensuring the property is safe and structurally sound. So for this reason, an FHA appraisal is more detailed than a conventional appraisal. It covers major structures, including the roof and the foundation, mechanical systems such as plumbing, electrical and HVAC, and interior condition, including carpet, paint, and handrails on stairs. While the FHA appraisal is thorough, it does not replace a full home inspection. Although the FHA appraisal does provide added protection for first-time buyers, sellers often see it as another hurdle to closing. For this reason, sellers may prefer conventional offers, especially in competitive markets. Additionally, sellers sometimes perceive conventional buyers as stronger or better, or maybe better qualified, which can make a conventional offer more appealing. This usually only comes into play in a hot market where the sellers receive multiple offers. So to summarize, FHA loans are specifically designed for first-time homebuyers. They address common challenges that these buyers face by accepting lower credit scores, shortening the waiting period after bankruptcy, allowing for higher debt-to-income ratios, but there are trade-offs for these benefits. But for many first-time buyers, these trade-offs are well worth it, especially when they make the difference between getting approved or not. On the other hand, if you do have higher credit scores, stronger income, and better assets, or if you're just not a first-time buyer, an FHA loan may not make sense because you'll always have mortgage insurance and because the FHA appraisal could make your offer less appealing to a seller compared to a conventional offer. Hopefully by now it's clear that which option is better for you depends on many factors, including your credit, income, savings, and your goals. Deciding which loan program is best for you often requires professional guidance. A mortgage loan officer can apply their experience and expertise to your specific situation to help determine which loan program makes the most sense. If you still have questions not covered in this post, please email me at ronpiro@barrettfinancial.com or call me at 614-502-6834. I'm happy to help you navigate your options. As always, best of luck and happy home buying.